All right, so I want to be respectful of everyone's time. We've already logged in. I know other folks will be joining us, but let's go ahead and get started. So thank you for joining us today. My name is Jason Dahl. I'm a certified financial planner and the Director of Financial Planning Services at AFS. I'm here today remotely, of course, with my colleague, Alp Adebeck. Alp is the founder and managing partner of AFS. Today, we will be discussing buying, renting, and refinancing, which is a brand new presentation of ours that we're excited to debut for all of you today. We have a great team effort putting these presentations together, so very excited, chock full of really good information. Now, but before we get started, I do just quickly want to remind folks to please ask questions at any time during today's webinar. You can ask a question by typing it into the Q&A or chat links at the bottom of your screen. I also want to encourage you to directly follow up with us after the webinar if you have further questions or would like to schedule a time to review a few things over a Zoom or just telephone call. Alp and I, our whole team, we really do love what we do, and one of the best parts of what we do is connecting with people and helping you solve personal financial planning puzzles. So please don't hesitate to reach out. I know we did get several questions ahead of time, so we're going to, I was reviewing those once again right before we launched, and I feel very confident that we are going to address all of them throughout the presentation, but I will go back and make sure that we cover all the questions we got ahead of time. And then I also just want to mention that we are recording this, and we will make the recording as well as the slides available. Those usually all get kind of ready and uploaded by next week. So without further ado, let's go ahead and launch into buying, renting, and refinancing. Oh, and like I said, our goal is to keep this under an hour, just as a FYI. So we will shoot for that. All right, so for generations, I think we've all been conditioned that buying a house is the quintessential, piece to achieving the American dream. And certainly there are many good reasons for buying a house, both financial, but as well as for our quality of life. However, I'll say one of our goals for today is to help all of you gain some clarity as to kind of the pros and cons of owning versus renting, and to know when the right time is for you to buy. I know for me, and I think not only in my own experience, but in working with numbers of clients, one of the most important decisions that you really need to kind of make right up front when you're thinking about buying a house is whether you are buying primarily as an investment, or is your motivation primarily to find your quote unquote dream house for you and your family. I'll say, what you want to avoid is kind of getting stuck in the middle, right? Where you kind of blend the two together. Now, of course, every house you buy, even if you're looking for that dream house for your family, you would love for it to also be a great investment, right? You would love for it to go up in value, and the neighborhood to continue to improve, right? All those things. But I will say, what sometimes folks do is they do kind of get stuck in that middle ground, and it kind of fogs their decision-making process and their priorities when buying a property, right? And I'll just, for myself as an example, my wife and I decided to buy a house for the first time here in DC. Gosh, this was back in 2008 is when we bought our first house here in DC. And one of the things, as I reflect back on it, that I really appreciated is that she and I were in total agreement that what we wanted to buy was an investment property first and foremost. Now, we were anticipating living in it, but we were looking exclusively, I'll say, for kind of 2 to 4 unit buildings that, like I said, we could live in one unit and rent out the others. We also kind of, in our criteria at the time, was we wanted it walkable to Metro, right? And so those are just a few of the examples of the things that we focused on, right, in terms of our purchase process and our searching for properties, right? We really focused on cash flow, right? The expenses, rental income, all those sorts of things. And I will say that having that clarity really was essential for us to find the right house, the right property. And I will add that, 12 years later, we are still living in the same house. And honestly, it has evolved into our home, and we can now start to see it as being kind of our long-term, quote unquote, dream house where we are raising our family. But I do think that first and foremost, that can really help you, right, in your process when you're thinking about buying a house.
So everyone automatically assumes that buying is better than renting, but if you really go through the numbers at times, and it really depends on how long you own a place, you could actually come to the conclusion that renting is better than buying. And we have a great handout that will be sent to everyone after we conclude. I don't know if it'll go out with, I'll say the wrap up in the next few days or so, but it really is a good handout that gives you the pros and cons of renting versus buying. On the pro side of renting, a lot of flexibility. Right, you can make a quick decision to move out and relocate, especially if your lease is, gotten to the point where it's month to month. Less responsibility. The landlord is generally responsible for all of the major repairs and maintenance. Low upfront cost, generally just a security deposit that you will get back if you take care of the place. So no down payments. Set monthly cost. Essentially, your rent is usually the big expense. Utilities and apartments are generally on the small side, so it really is just about the rent. And as I said, no major repairs. No additional taxes or fees. The pros of buying: stability. If you own the home, it's your home. Nobody can technically take it from you as long as you make the payments, and if you pay it off, it's yours for forever. Essentially, freedom. You can renovate anytime you want. You can just make any type of upgrades. You don't have to really go to anybody to get approval. You potentially can build equity in a home, and that's generally a very long-term process. It doesn't happen I'll say it's temporarily happening now very quickly because people have been bidding up some homes into price wars, but typically it's a long-term, I'll say, issue to really build equity. There's tax benefits for owning a home. The mortgage interest and real estate taxes are deductible, but these days they're subject to limitations. So that's something you really need to talk about with your tax advisor. Stable monthly payments. If you buy a house and you get a 30-year loan and you've locked it in, fixed 30-year loan, that your payments will be the same in 27 years as long as you don't refinance. So compared to rent, your rent will go up substantially. If you were to stay in the same place for 27 years, you're going to be paying a lot more over that time period. The cons of renting: your rents may increase. No equity, right? Doesn't matter how long you rent, you're not building up any equity. No tax benefits. You can't really customize the place. You've got to worry about pet policies. If you're in a building that says no pets, then it's no pets. The cons of buying: more responsibility. As a homeowner, and I've been a homeowner for a long time, I would tell you house projects take a lot of time and can be costly. If you're a do-it-yourselfer, that makes it a lot easier. High upfront cost, down payments, less mobility. I mean, most people, when they buy a home, they're not planning on moving, every couple of years just because they found a better place. So, you're generally anchored down more. Property taxes. I joke during the credit crisis back in 2008, 2009, when property values went down, I noticed where I live in downtown Bethesda, it seemed like the property taxes had a way of still going up during the credit crisis, which didn't really make sense. One of the also negatives is there's no guarantee that the valuation of the property will go up. And I'll say, when it comes to the maintenance cost, they are always there, and they typically, the bigger ones, I'll say, seem to always come at unexpected times. So how do you know if you're ready to buy? Jason, if we want to move to the next slide. A few big factors. For me, one of the biggest ones is if you're in a good place financially. And the best way to think about that is if you have reserves and have got all your bills paid off and nothing really surprises you, you never have to go into debt to kind of pay a credit card bill, then I would tell you that you could consider looking at buying. But if you're still in a situation where at times you're struggling to make ends meet, I would tell you just slow down a little bit, try to get your house in order, your financial house in order. And so take some time. And I'll also say, if you're not ready to commit to a certain area for at least 5+ years, and I'll say 5 to 10 years, it's also not worth it. So if you're thinking, I'm gonna live in DC for the next 3 years, but maybe I'm gonna move to New York or wherever, it's really not worth buying. Again, the people that get lucky there with some type of, I'll say, price appreciation, it's on the rare side. So, think it through.
Thanks. Yeah, and I was just add a couple kind of add-ons to what you were saying, Alp, is sort of that that kind of 5 to 7 years. Do you expect to stay in the house? Some folks may say, well, maybe I'm not going to stay in the house, but I plan to continue to own the house beyond that period, but I plan to rent it out. Yeah, and that's where again you can kind of get into that gray area when you're looking to buy something. If you went into it knowing that, hey, I'm looking at this as a potential investment property, something I'm going to be able to rent out. And I know one of the questions we got ahead of time was around, what needs to go into when you're considering renting out your property. But that can really help, because what we have seen is sometimes folks, they buy a place, they think they're buying it just as their house to live in, and then maybe 3-4 years later, for whatever reason, they're moving and they think, oh, well, I'll just start renting it out. Well, maybe that's going to work, maybe it's not, but you can feel much more confident that it's going to work if from the beginning you'd really gone into it thinking about those many factors around, is this a good rentable property?
I think that's a good point. And I'll also add, most of you wouldn't know this about me, but I'm an ex-tax person. I used to do a lot of individual tax work, have since walked away from that business. But essentially, you could actually get into a little bit of a tax trap. So if you, let's just say you purchased a house 20 years ago and you're moving out to buy a new place and you want to actually rent the home, one of the things that you need to discuss with your tax person is you potentially could sell your house. And let's say you have, if you're a married person, if you've got $500,000 of gain in your property, if you sell it, you can actually, I'll say, avoid paying tax on up to $500,000 of gain if you sell it as a personal residence. If you sell it as a rental property, it's a different answer. You basically will pay tax on that gain. And so you have, I'll call it 2 to 3 years to play around with that decision, but you really need to talk to a tax advisor to see if you have any type of gain problems with your house if you're thinking of converting it into a rental property.
Yeah, another great point. And last one here, I'll just mention too, is just kind of the longevity and how steady your income is definitely, I know lenders kind of look at that, right? They have a criteria there, but also just from your own perspective is, be honest with yourself, and if you're with a partner buying a house together, say, hey, it is our income, do we feel confident in our income that it's going to be able to support and justify buying a house? And kind of to that point, as many of you have probably seen before, if you've attended any of our workshops, we have our hierarchy of financial needs. And as I always say, all of us we're somewhere on this hierarchy, right? We might even have, 1 foot on one level and another foot in another level, right? Maybe straddling a few different levels in the hierarchy. But what we wanted to just kind of focus on for a moment is kind of building what Alp was talking about, right? Making sure that your financial house is sturdy, right? The foundation is strong, right? That you got the emergency savings that you need. You're capturing any free money through a retirement plan matching program. You're focused on paying down the high interest debts, right? So if you have credit card debt or student loan debt that are above, typically for us, the threshold currently is around 6%. So if you have a debt that the rate on that debt is 6% or higher, that would kind of fall in our bucket of high interest debt. And you'd want to kind of prioritize those, pay those down sooner, right? And then it kind of expand on the emergency savings, right? So you want to have both enough to cover your expenses if you were to lose your income, right, for a 3 to 6 month period. But then when you're starting to think about buying a house, I'll say it's even more important to not only have emergency savings to cover lost income for a period of time, but emergency savings to cover those irregular expenses that are going to come up from owning a house, right? They're going to happen no matter what, and you have to be prepared for that, right? And so that's where kind of the arrow comes in here is you really kind of want to make sure that all the levels there in the red, orange, yellow are strong, right? That you can check those off in the hierarchy, and now you're really starting to focus on goal-based savings, such as a down payment on a house. Here's just another kind of simple sort of cheat sheet, if you will. It's just kind of thinking about some recommended spending ranges, and as you can see here, Housing utilities, right? That combination of both, whether it's rent or the mortgage, plus kind of the, the utilities, right? The recurring, known expenses related to housing. If you're in more rural areas, some folks may be closer to the 20%. Right here in the DC region, it's probably going to be closer to 40% there. But one of the things that I always like to talk about is just kind of focusing on the middle of this screen here. So the three savings components, right? That really needs to be priority number one. Hey, am I on track? Do I have my emergency savings on track? Do I have my retirement savings on track? Do I have my goal-based savings on track, right? I mentioned down payment on the house is one example of goal-based savings, but it also may be, college is another common kind of goal-based savings account for kids or maybe even grandkids, right? But if you feel really good that, hey, we are on track in those areas, sort of everything else kind of flowers from there, in my view.
And so this is a good one to think about before you are purchasing. How long do you plan to own? And we really, and we can already kind of see from what we said, we look at homes as a long-term purchase. And the main reason, in Maryland, DC, and Virginia, basically closing costs are high, both buying and selling a house. And the reason that impacts things so much is if you plan on selling in just a couple of years, and let's just say when you sell your house, you're going to pay a real estate commission and other closing costs. Let's say that adds up to about 8% of the sales price. That's a lot of money. So if it's a $500,000 house, you could be talking about $40,000 of closing cost. And so if your home did not appreciate that much, that means you'll generally be in a loss scenario. So, it really is not cost effective unless you own it for a longer period of time. And even then, there's no guarantee that prices will appreciate, which is a good segue into the next slide. This is just a chart of just recent years, what probably has got a lot of people excited about buying a home. And it just shows you across the country that you've seen prices appreciate a lot. And I would tell you that the primary reason properties have been going up, and I'm not talking about in the 2020, some of it I'll call it as pandemic related. People have been moving out to the suburbs and we've seen price appreciation there for the first time in a while. A lot of it really has been because interest rates have gone down. Where, when I bought my first house in 1989, my mortgage was 10.5%. And, right now I'm sitting on a 3% mortgage for my house. And so, there's a big difference. So those lower mortgage rates, people can afford a lot more and they tend to bid up a house to what they can afford. So if they can afford a $3,500 payment, that's how they think about it. And if that means that they can bid up the price, they will bid it up to get the home that they want. So, no real guarantees. Neat little map to just show you that prices have appreciated over the years. So generally three types of properties. Everybody knows this: condos, townhouses, and houses. And there's also co-ops that kind of fall into the condo crowd. But on the condo side, a lot of times they get, I'll say, a bad rap because people always talk about the condo fee is so expensive. But one of the things to think about when you buy a condo is the condo fee covers basically all of your expenses, typically outside of your unit. So the hallways, the elevators, the outside of the building, the roof of the building, all of those major expenses are covered by your condo fee. And if you've got a fancy building, it could actually cover some concierge services. It could cover a gym, swimming pool, etc. So all of that, in a sense, is part of the condo fee. So something to think about. On condos, I will say one of the things, if you're really interested in a condo, and I'll say specifically on like the one or two bedroom side, take a look at the price history of it. And I know recently I was helping somebody look at condos in Bethesda, and I was just showing them that the history for the last 20 to 30 years in Bethesda on a lot of these condo units, they just have not appreciated, especially like the one bedrooms where maybe a property 20 years ago sold for 300,000 and today they're asking, 289. So something to think about. On townhouses, it's kind of like that gap between the condo and the house. Homeowners Association generally covers a lot of things, and it varies by, I'll say, neighborhood that you're in. It could cover I'll call it the lawn maintenance, and it could cover the exterior of your place. So that could be something you have to monitor and check for. When it comes to a house, this is the big difference. Basically, you're responsible for everything, whether it's a tree in your yard, whether it's the exterior of your house, the interior of your house, every, I'll say, appliance in the house, that's all falling on your shoulders, period. So, one of the drawbacks of home ownership, it generally costs a lot more versus owning a condo or a townhouse.
And there are a lot of condos coming online in this region.
Yeah, without a doubt. And one of the things also on condos you'll hear about occasionally is if there's a special assessment, and that's if there's a major repair that the condo association did not have enough reserved for. That maybe they're going to redo, the roof, or I'll say they might have a lot of the central air conditioning units in the common areas that needed to be replaced. And if they didn't have the proper reserves, they'll assess what's called a special assessment, which means that you have to pay, in addition to your condo fee, a lump sum.
Yeah, well, yeah, we've definitely seen some big ones on occasion. And another great kind of segue here, thinking about, how much can you afford? And so I'll sort of back up, and I know the thing that most people focus on, right? The primary driver when folks think about, okay, how much house can I buy? How much house can I afford? They really just, they look at that monthly payment, right? And they say, hey, I can afford that given my current income. A lot of that is driven by what Alp talked about, these historic low interest rates, right? So we can afford more house because interest rates are so low. But I cannot emphasize enough all the other costs of home ownership, right? And this isn't to scare you away, but it's just to make sure that you go into it with some clarity. Alp touched on a lot of those, the condo fees, homeowners association fees, kind of what goes into those for the maintenance and things. So really I want to make sure that everybody goes into it saying, hey, we've got enough savings, enough emergency reserves for those irregular expenses that are going to happen, right? But then when you think about kind of what's the price range you can start looking for. So kind of traditionally, lenders want to see, sort of a cap of 36% of percentage of total debt payments of your gross income. Okay, so just being clear, of total debt payments, right? So if you add together the debt payment that you're looking at taking on for the mortgage, plus any other debt payments that you have, car loans, student loans, credit cards, etc. Now, if you have things like credit card debt, you might want to double think and before you go into buying a house. But 36%, that's just kind of the traditional rule of thumb. It is not hard and fast. We were talking about this right before we kind of launched the presentation today. We are seeing that there are lenders that will go above that. I think somebody told us recently they've seen it go up to 50%, but that's going to be for folks that have strong credit history, strong credit rates.
And generally strong assets in that scenario too, where there's something else to back them up. But it is interesting, like how much can you afford? So really have to think it through. Jason, if we go to the next slide.
Yeah.
Actually, I'm going to go skip up too. So you do go. I apologize, Jason. Go ahead. I'll wait. It was one more. I missed. I'll say counted the slides.
Yeah. No worries. Yeah, and so actually, just a couple other just quick comments I want to make about affordability is one, it's not the end of the world if you continue to rent for a while when thinking about affordability, right? You want to go into a house where you can feel good that you can afford that house and not sort of regret that purchase. And I know we've had a couple questions about sort of the pre-qualification process and when you should do that, and we definitely recommend it. We're going to talk about that in more detail here in a moment. But even before kind of that pre-qualification process, it's going to start narrowing in to give you a much greater sense for how much you can afford. What you need to be doing now is living within, I'll say, or below your means, right? So that those are just like that hierarchy, right? Are you kind of checking off those key financial sort of habits and benchmarks along the way? So something that we're actually seeing come about more recently is, I'll say, we just sort of broadly refer to as unmarried couples um, buying houses together. Now, this could be, right, boyfriends, girlfriends. It could be siblings. It could be just friends. It could be with parents, right? So any kind of combination of buyers that aren't sort of your traditional married couple, and we're seeing more and more of this. And just a few things you want to kind of to think about is just, I know you don't want to think about the worst case scenario, but it's important to kind of think about, well, what if the relationship doesn't work out? What if one of the parties says, gosh, I got a job transfer and I'm leaving out of the area, and you know what, I don't want to still be an owner of this house, right? Who's going to be listed on the title? Who's going to be on the mortgage? Right? So, and who is actually purchasing the home, right? Is everyone going in equal when it comes to the down payment and making the mortgage payments, which we do see sometimes, but other times we see, well, one person has enough to do the down payment, but then you're going to sort of try to make that up via, a differential in the mortgage payment, right? So there's a lot of variables that can go into it. Doesn't mean it can't be done and it can't work out, but just the main point, it really is, write some things down. Make sure everybody is in agreement. I know there are, sort of real estate attorneys that can kind of help with just sort of a basic, structure. But even before talking to the attorneys, right, just between you and then your partner and buying a property, think through those different scenarios and write down, hey, we're going into this with a clear kind of understanding and expectations.
Essentially of what could happen if, for as Jason mentioned, somebody moved out of the area, relationship ended, whatever it may be. I mean, we see a lot of, I'll say, avoidable headaches here. And this is the slide that I actually thought was next, and so I apologize earlier what I mentioned earlier. But yeah, so the debt to income ratio, Jason was talking about it, and just an example of it. Like if you have, let's call it, $120,000 salary, so that's $10,000 a month. If you look at that 28 to 36%, monthly payment, I'll call it debt to income ratio. So in that example, if somebody had $10,000 a month, basically they can afford a mortgage payment of, around 2,800 and all in on the debt side to about, 3,600 a month. And it matters. I mean, one of the things, like when we go back to the hierarchy of financial needs, is we want to make sure that you're still funding things like your 401k and HSA, et cetera. And so, sure, you can stop a lot of those things, but and so if you end up being more aggressive, saying I'm getting a more aggressive house, you can stop a few of those things. You can say you can do it on a temporary basis until you make more money. And you have to worry that, well, what if that doesn't happen, right? So it's something really to think about. We're big advocates of trying to be conservative here and not stretching yourself too thin on it.
Yeah, yeah. And I know, Alp, you're going to touch on here on the next slide a little bit, kind of the mortgage insurance component, if you aren't able to put the 20% down, and just making sure you calculate that into the
Right, so a lot of different types of home loans out there. The most common ones are the 15-year and 30-year, and I'll say by far it's the 30-year mortgage, but lots of different options and lots of different costs. And as Jason mentioned, if you don't put 20% down, you're going to generally likely be subject to mortgage insurance. We have seen some workarounds where at times we've seen situations where somebody will get I'll say, the equivalent of 20% down, because they'll have a home equity loan come in at closing, essentially, that helps them get around it. So there's a decent amount of flexibility here. This is why it's really important to work with a good lender, somebody that you've, I'll say, grown to trust in a very short period of time that can help you work through the, I'll say, the various options out there. But really, the most common thing we see right now is a 30-year loan. You'll also notice that the more expensive the home is, you could see different financing costs. So there's conforming loans, jumbo loans. At times they'll have 2 or 3 different tiers of loan levels, and they will dictate like where the mortgage interest rate will slot in. Separately, right now, one of the things we're noticing, 15-year loans are substantially cheaper. And so right now we're seeing a gap between 15 and 30-year loans of about 0.5% in interest rate. I've seen some 15-year loans on purchases right around the 2% level, and we're seeing 30-year loans coming at 2.5, 2.6% or so. And so if somehow you have the income to be able to I'll say a 4 to 15-year loan. Basically, it's exactly like it sounds like. That house will be paid off in 15 years, which is a really nice position to be in, especially at a young age.
And the savings, right? The total amount of interest paid over the length of the term, is significant, right? When you've cut that amortization table in half, essentially.
Yeah, and in the old days, you saw a lot of adjustable rate mortgages. We see very few of those right now, and they are just not competitively priced. I mean, and what I mean by adjustable rate, sometimes they would have it where it was the first 3 years of the loan was fixed. So it would be a 3-year arm or a 5-year arm or a 7-year arm. And so the loan was fixed for those periods. Then it would turn into a variable rate after that. And they're just not competitively priced now, which I think is a good thing. And so everybody's focusing on, 15 and 30 year, and you can get 20, 25-year loans, but the main ones we see are the 15 and 30.
And Alp, I think also it's helpful to just clarify, because these can get really confusing, all the different kinds of loans. Just one other finer point on kind of the ARMs, the adjustable rate mortgages. So whether it's a 3-year, 5-year, 7-year, 10-year ARM, the number that they're referencing there, right, the 3, 5, 7, 10, is just how long the interest rate is fixed. But the length of the loan generally is over a 30-year amortization, right? And so that I know that can be confusing for some folks when you're first just sort of looking at that and you're thinking like, oh, so is this only a 5-year loan? Well, it's just the rate is for 5 years in that example. So I know we've had a couple questions come in just kind of around the pre-qualification, pre-approval process. So far, we've really kind of been focusing on the, let me just call it the pre-qualified process, right? Just on your own, making sure you check off, right, the hierarchy of needs, the income, levels, your spending ranges, your savings ranges, right? That you feel confident that you've got the right amount of emergency savings. That's kind of the pre-qualification process. Then once you feel good about that and you say, hey, I think I want to get serious about looking to buy a property. So then you can go through sort of the proper pre-qualification process, right? Working with a lender. Now that could be, a traditional bank lender, a mortgage broker, a credit union lender, right? Generally, they'll all kind of have a questionnaire they'll ask you to fill out. And they're just going to sort of, based on that information that you provide to them, such as, hey, this is how much my income is, this is what I have in savings, these are my current debts, right? That sort of information. They'll just kind of give you an initial, no obligation, it's not final. They're just going to say, hey, based on what you shared with us, we think you would qualify for, sort of a loan range. Sometimes they'll give it, or sort of a maximum loan amount. But then kind of the key differential when it sort of goes from pre-qualification to pre-approval, I'll just sort of simplify it to say, when they start asking you for documentation, right? Verification. Okay, send us your W-2, send us your 1099, send us your tax return, send us actual bank statements and, brokerage account statements. That's when they're sort of, you're getting the formal sort of pre-approval. They go through that process and the lender will make a formal kind of, offer with a specific loan amount that say, hey, yeah, you are approved to, buy XYZ house at $600,000, whatever it may be. So that to me is kind of the progression, the process, at a high level. So I know we also had a question around down payments, and somebody asked about, well, what if a family member wants to kind of gift you money for a down payment? And we tried to kind of make this slide so that sort of the quote unquote best source of a down payment is the biggest biggest piece of the puzzle, right? And let's just be honest, if someone wants to give you money, right, no strings attached, not a loan, just a gift to make a down payment, that is definitely the best source. Now, not all of us are fortunate enough to have a benefactor as such. So probably the most common source, and I'll say the next best kind of source, is just through your own personal savings, right? That's kind of, you've proven out that, hey, I'm disciplined, I'm living below my means, I've been able to build up my personal savings, hopefully, right? You've checked off all the other boxes that we've talked about, and hey, I can use that as my source for the down payment. Some instances, you may be selling some other asset to use towards the down payment. And that can be any number of things. We're not going to kind of go into great detail there. If somebody has a specific scenario they'd like to talk through, feel free to reach out. But then the one we want to kind of caution against is drawing out of a retirement plan. Right. There are a lot of different reasons why, some tax reasons why you don't want to draw out of retirement plans early. There are some, provisions where you can avoid some of the penalties and taking out for down payments on houses. But I'll just say, kind of in the big context of your financial planning and the hierarchy of needs and everything we've really been talking a lot about today, is you want to avoid that, right? Because your retirement savings is for what? It's for your retirement, right? And you want to keep that focus because you want to retire someday, and no one is going to give you a loan, to just pay for your retirement someday, right? So just generally speaking, our advice is try to avoid drawing out of the retirement plan.
On the subject of a gift, if you do get a gift, you'll notice that your lender will ask for a gift letter from whomever gave you the gift to prove that it was not a loan, because they will actually look at your bank statements, and if they see any large deposits come in that can't be traced to your salary, they will ask you to explain that. And if it was a gift from a family member, they'll just simply ask the family member to sign off on a piece of paper that says it was a gift. And another thing on the sale of assets, if you do sell something and you're in a taxable situation on that, so if you sold, say you owned Apple stock and it appreciated a lot, you will pay tax on that. So you have to factor that into your calculations also.
For sure. Yep. Two very good points. Yeah, because the lenders are generally going to ask for several months history of bank statements, right? And they want to see, oh, did you just all of a sudden have a big lump sum come in? And they're wise to that, to say, well, is that really is that your money? Is it really a gift? Is it a quiet loan? Like Alp was saying. So one of the other things that I think a lot of folks just kind of don't give it enough attention, right, and sort of factor it into their calculations. So it's just that broad umbrella of closing costs. Alp talked about this before, right? In this area, DC, Maryland, Virginia, it's relatively expensive just to buy or sell a house. And we're not even talking about just the actual cost of the house, right? We're just talking about all those other mouths that get fed, right, in the process, in the real estate industry, right? You've got the real estate broker who's helped you, right? The lender, the title company, right? The surveyor, the appraiser, right? The inspector, right? There's just so many other pieces to it, and all of those things get detailed out on the settlement sheet, and I'm already forgetting. There's a new title that they're calling the settlement sheets. I'm going to keep calling it the settlement sheet, where basically line items out. Okay, here's all the various expenses that go into it, and who's paying it, right? Is it the buyer or the seller? But no matter what, always remember, even if it's in sort of the other column, right? If you're the buyer and it's listed in the seller column or vice versa, you're still paying for it, right? Like all those things get factored in, kind of the underlying price of the house. And sometimes I think folks sort of discount that too much and just saying, yeah, I am paying for that because it's it's all reflected in the price of the house, generally speaking.
And it's good to remember some of the, I'll say, if you're looking at what's happening in the seller's column, because someday you'll be the seller.
Yep.
Right.
Yeah.
It's like, oh, that real estate commission, right? I mean, that is a seller obligation because they're the one selling the house. So, but it can be a meaningful number.
Yeah, it's a great example, right? If I'm a seller of a house and I know, hey, it's my obligation to pay the realtor, well, I'm factoring that into the price of the house, right? Because if I know it's going to cost $20,000 towards real estate brokers, well, that's going to eat into what I'm going to walk away with after the sale. Well, I'm probably going to try to if I can, increase the price of the house.
So we've talked about mortgages. And this is just a good example of, for example, like what would a $400,000 mortgage cost? And you know the term P&I, that's principal and interest. So if you take out a $400,000 loan at 3.5%, rates are a little bit less than this at 3.5%. Over 30 years, your principal and interest payment would be $1,796. If you do a 15-year loan, and this is at 2.5%, your payment would be $2,667. Now, in addition to those payments, you'll also have to pay taxes and insurance. And so you hear that term PITI. And so, for example, if you have real estate taxes, these get paid annually on a home. And so if you're looking at the house that you're purchasing or condo, whatever it may be, and the real estate taxes are $8,000 annually, that's something that you have to actually have added to your mortgage payment, because usually those are thrown into what's called escrow. Sometimes you can pay for those out of your own pocket, but most people have it paid through escrow. And so on an $8,000 real estate tax, you're going to pay an extra $666 on top of your principal and interest. And if you have insurance that costs $1,200 a year, that will be an extra $100 to your payment. So again, great examples here. You can see what the cost would be for a $600,000 mortgage as well. So, kind of good to kind of run through these numbers. There's a lot of calculators available online that you can just plug in different loan amounts. And it's pretty straightforward to kind of say, oh, this would have cost if it's a 30-year loan, and if it's a 15 or 20 or 25 also. On home expenses, probably the most important thing to remember, and we bring this up over and over again, and I'll just call it the 1% rule, and budget about 1% of the value of your home for home maintenance on an annual basis. So if you're buying a $600,000 house, generally it's about $6,000 a year for just home maintenance. And it's not going to happen every year, right? You could have some years that are really, really cheap, but then you're going to get hit fairly quickly on a couple things that happen all at once. And so it's kind of good to kind of reserve it. And it's funny, back in my tax days, if I was working with engineers at times, they would love to have separate accounts for everything. They would actually put the money in a separate account to be prepared for those bigger expenses. I recently bought a second home down in St. Michael's, Maryland, and 2 years after I bought it, despite the home being relatively new, we had to replace one of the heat pumps in the house, and it ended up costing, I think, around $13,000 or $14,000 all in. So it can just happen. So it's, something to think about. In addition, you're going to have, yard maintenance, utility bills. And if the house is an older house, you'll notice things like utility bills will cost a lot more than compared to a new house, and also compared to like a condo or a townhouse. We've talked about real estate taxes. If you're buying an expensive home, some areas the taxes are more expensive than others. You could be in certain districts that, you could see, oh, your friend's house they bought maybe 15 miles away, similar house, maybe their real estate taxes are 7,000, and you're buying a place that's very similar, but your taxes might be 8, 9, or 10,000. So that varies. And just also things like new appliances, like if you want to put a new refrigerator in, all of those things cost money, washer and dryers, etc. And if you do some of the stuff yourself, obviously it's a lot cheaper to fix things and to replace things. But if you're paying for landscaping, we always say in DC at times you're going to have DC prices, right? The people know that generally around this area, homes are more expensive. You'll pay more for repairs, yard maintenance, etc. But something to keep in mind, that the expenses are always going to be there.
Yeah, and it's kind of a segue to the next side, building out your team. If you think about it, right, one of those team members, right, is, if you're buying a house, is the home inspector, right? Somebody who's going to come through and just, a relatively kind of simple, the home inspectors aren't, kind of pricing out like, oh, hey, you're going to need to, fix in great detail, right, and what that's going to cost, right? But a home inspector is important, but sometimes you may even want to have, I'll say, that sort of that next level of a contractor, right, to come in, because I always like to talk about like just sort of the deferred maintenance of a house that's being sold. If you just think about it, sort of the nature of it is if you're selling a house, other than the things that you sort of talk about with your realtor about, like, hey, you've got to fix these things so it's going to show well, right? But the things that aren't necessarily going to show well, you're not going to worry about spending money and fixing them, right? You're going to defer that maintenance because it's just not really in your best interest. And so as the buyer, I always tell folks, just assume, even if it doesn't show up in the home inspection, that there is going to be some kind of deferred maintenance cost that's going to pop up that first year. I've yet to see anybody buy a house, any price level, that didn't, after a few months go, gosh, darn it, the dishwasher went out, or right, like whatever it may be. And so I actually want to pause for a moment. I'm going to look back at my question list here, make sure that we are
There was a new one that asked about what's
Yeah,
the 1% rule we talked about. That's generally 1% of the home value is what you should kind of reserve for home maintenance expenses. So if I didn't go over that enough, I apologize. So again, an $800,000 house, just kind of factor in about $8,000 a year, and it's not going to be every year.
yeah.
Some
And
years will be
right,
12, some will be, 6 or 4.
yeah, but that's kind of the average. Yep. And that's kind of the trade-off when you have a condo fee, right? You sort of go into that and saying, hey, part of that kind of 1% each year is built into that condo fee. I wanted to pause for a moment. We had a great comment and question kind of around mortgages and recasting of mortgages. I know, and it was sort of refinancing and recasting. We're going to talk a little bit more about refinancing here in a moment, but recasting of mortgages. This is a relatively new kind of piece to the mortgage marketplace, at least relatively new to me, looking at it over the last maybe 3 or 4 years. And in short, it's kind of a cool feature that let's just say you take out a 30-year mortgage, and this mortgage allows you to quote unquote recast it. And what that basically just means is, so let's just say you have a $600,000 mortgage, but you're expecting, at some point, you're going to sell another asset, to Alp's example, right? Or you're expecting a big gift, maybe even better. And you know that, hey, in a year or two, I'm going to have a lot more money to kind of pay down that mortgage, right? And so rather than having to refinance the entire mortgage, right, and pay it down, and then get a whole new mortgage, you can recast it. And you got to make sure that the lender allows that. But you can just make that large, say, $300,000 payment. You don't have to go through all the expenses in the process of a full refinance.
So your interest rate's going to stay the same. It's
Yeah.
still going to be a 30-year loan. And the difference is if you actually were to take a lump sum, and so you had a $600,000 mortgage, if you put $200,000 in one payment against that, and so your balance has dropped to $400,000, your payment, unless you recast it, will stay the same. So essentially, you'll just pay your house off faster. But if you recast it, they basically will configure a new mortgage payment.
Yeah, recalculate it all. Yeah, so it's a really cool feature. You need to ask your lender, hey, is there a cost to the recasting? How many times can I recast? All those sorts.
And if they offer it.
And if it's even available. Yep. Yeah, so another piece here, we touched on this a little bit about your team. We've really talked about all these different areas, right? Whether it's your realtor, the appraiser, the insurance agent. And we had a question before, it's kind of asking, hey, do I have to sort of use all the people that my realtor wants me to use, right? Whether it's the title company, the appraiser, so forth. You don't have to, right? Most realtors, have folks that they're comfortable with, that they're confident in, that they do a lot of work with, and they're going to, generally try to kind of steer you to those folks. But you don't have to use all the people that they suggest to you. Same deal with mortgage professionals. There, I definitely recommend, right, that you shop it around and negotiate on the mortgage front. Look at a traditional bank, look at a credit union, talk to a mortgage broker, and let them all know. Just be honest. Hey, I'm shopping this around. This is a big financial decision, and I want to make sure I get the best mortgage, the best rate, the lowest closing costs that I can. And then I will just kind of make one other comment. I mean, all of us, we all have a friend or a friend's mom or somebody who's in the real estate business, right? And make sure, rather than just saying, sure, buddy, I'll work with you. Make sure that they're experienced, they're qualified, they can help you, right? Because things come up, right? And that's where you want that experienced realtor, where hey, if everything goes smooth and there's no issues, then no problem, right? But there sometimes different things come up and curveballs get thrown at the buying and selling process, and that's where the kind of the experience of a more seasoned realtor can really pay dividends. Talked a little bit about this, certainly about kind of negotiating with mortgage, lenders, or at least, comparison shopping, on the realtor front, right? Sort of the traditional realtor commission is at 6%. That kind of gets split 3 and 3. We've started to see some more pressure on that over the recent years. Part of that's
hold on one second.
Oh, yeah.
Just the real estate commission is a seller expense. I apologize. It won't be split 3 and 3. 3 and 3 between the two buyer
between
and
the
seller.
two.
Yep. I'm
Yeah,
sorry.
between the two agents. Yeah. That's what
Just
I
want to
meant.
make sure we clarify that. Sorry about that.
Yeah. No. Yeah, good to make sure we're clear. Yeah, so the 6% is generally split 3 and 3 between the buyer's agent and the seller's agent. And some pressures come down on that, in part from, kind of the Redfins of the world. There's just a lot more kind of online brokerages, and they've been putting downward pressure on some of those rates. I'll say, not it doesn't always have to be just that 6%, right? Let's just put it there. I'll say kind of one extreme example is because of so much more that's available online. If you're a buyer and you've kind of done a lot of the research yourself, you've already identified that this is the house I want to buy, and this is the house I want to make an offer on. I don't need to, be driven around and shown lots and lots of different houses. I just want to buy this house. Well, that's, to me, a good opportunity to kind of negotiate that commission, because hey, in reality, the agent is doing, doesn't have to do as much work. But again, hey, well, maybe there's something complicated about that transaction. Well, then that might influence the.
And I'll throw out another good example is if you're buying and selling in the same region, and you're going to use the same real estate agent to basically help you sell your house and buy the new house, you can generally negotiate a really big difference in the rates there, because they're going to be getting paid off both sides of the transaction. You might get them to, I'll say, lower the selling commission substantially in that example. So something to think about. And I'd also comment that, today it's really difficult to negotiate on the purchase prices because we're somewhat in I'll call it seller's market, and there's been bidding wars out there. Personally, I dislike bidding wars. I tend to think that if you I'll say, pay for a home, it might be something that you're going to pay that price 10 years later, where, it's just, I have a client right now that's bidding up on a house, and when they sell the house 10 years later, they might kind of lose money, right? As simple as that, where if they pay $1 million for something that, 6 months ago was worth 850,000, it's going to be tough to recoup that, and I'll call it in a different market. So it's
and
tough to get in those bidding wars to me.
Yeah, and to that point, I think it's a great point, that back to something we talked about earlier is, right, the vast majority of folks, when they're buying a house, they hyper focused on the one thing: can I afford that monthly payment, right? And while yes, you might say I can afford that monthly payment even after a house has been bidded up, but you got to sort of look further down the road, to Alp's point, to say, well, but if you bid the price up, even though you can afford the payment, that just doesn't give you any kind of potential wiggle room, in 5-10 years if you're selling it, to say, gosh, did it really continue to appreciate?
And you'll hear a term today called the escalation clause. And so, the real estate agents might talk to you saying that we know there's going to be multiple offers on this house, and they're going to ask you, how do you want to structure your escalation clause? And that's basically a fancy way of saying, if they can get multiple people to put in escalation clauses, it's automatically going to bid up to the highest escalation clause. So, if somebody says, I'll do an extra $100,000 in $5,000 increments if necessary, if they get somebody to do $80,000, that's automatically going to go up $85,000 in that example. So it's really something you need to think about. I know it's difficult if you have your heart set on a property, but I'll just say, be careful. I'm a big believer of, at times, you just got to step away because it just gets a little too crazy. But that's our advice, and everybody's got to make that decision themselves.
Well, actually, before we talk about NACA, there was a question: is now, or is it the best time to buy when COVID is so active? Great question, right? I mean, there's a few different layers to that. I think, one is certainly kind of your own personal comfort level, right? And risk comfort with risk, and going and shopping to buy a home. I do know that there are, protocols and, for safety protocols for, masks and fewer people in the house, if anybody, when you go to, view houses and all those sorts of things. I know the realtors, are for the most part, anybody I've talked to, they're very cautious about that. But then, I'm not sure if maybe the question is more just sort of about, just the marketplace, given COVID. And it's been kind of interesting. Al mentioned this earlier. we've seen an uptick in a little bit more of the rural, suburban and rural real estate. We've noticed as folks just kind of want to have more space again in the current environment. And we've seen some downward pressure in the really, densely populated areas, think like Manhattan, San Francisco. From all accounts, we haven't seen that same sort of downward pressure in DC. To me, I think part of that is just it's not as densely populated as those other two examples. We keep hearing about, those bidding wars in DC. But I hope that kind of helps with your question. We did specifically have a question about the Neighborhood Assistance Corporation of America, so that was a great lead in here. It's an organization that's been around many years. I think they do a lot of things, even more than I'm familiar with, but I think the one thing that we just kind of wanted to emphasize here is there are a lot of first-time homebuyer programs across the country. There are some federal first-time homebuyer programs. There are state level first-time homebuyer programs. There's, here in DC, there's one. They kind of evolve and change over time. And the Neighborhood Assistance Corporation of America, I think, does a really good job of keeping up to date and walking you through and even comparing, right? Because you may say, oh, should I take the federal one or should I take kind of the local first-time homebuyer program? And what are kind of the different rules that go into that? So that's why we just kind of want to highlight that. And so far so good, I think, on the question. So let's keep moving here.
So on the subject of refinancing, it's obviously a hot topic, and it seems like it's been a hot topic for years and years because rates have just gone down and down. As I mentioned, when I got my first house, I was paying 10.5%, and I'm really going to age myself. When I was doing taxes in the 80s, people were paying 18% for mortgages, right? So we're a long way away from that, but what has actually happened is people have refinanced over and over and over again. If they've maintained their same house and at one point they were paying 15%, they're probably in, generally like anywhere from a 3 to a 4.5% mortgage these days. And so the big question is, when should you refinance? And it's not right for everybody. You have to think through. We've got another slide. Just we'll talk about refinancing tips. And if you think about it, for some people, if they're already at, I'll call it a modest rate, so let's say 3.5%, and maybe they can get a new 30-year loan at 2.75%, they really have to run the numbers. Are they really saving enough money to make it worthwhile when you factor in the closing cost, especially if you're not confident how long you're going to stay in the property? So there's a lot of factors that come into play. So for example, if you're fairly confident that you're going to be moving in 3 or 4 years, then it may not make sense to refinance. If you've got a 30-year loan that you've paid on it for 9 years right now, and maybe your current loan's 4.5%, and you might be able to get a 15-year loan at 2%, I really think it's important to take a look at that and evaluate, can you afford that 15-year? Because one of the drawbacks of people refinancing multiple times is what we've seen over the years is somebody bought a house 25 years ago, and in the old days, in a typical 30-year mortgage, they'd have 5 years left on their mortgage. And what we're finding today is, we're finding people close to their retirement years, and they still have 27, 28 years left on their mortgage. So it's something to think about. And we've also seen people at times use their houses as piggy banks where, they've borrowed more money against their homes. They might have bought a house for $400,000, and 20 years later, the house might be worth $800,000, but their loan is now $600,000. And some of it might have been used to upgrade the home, but at times we've seen it, being used for paying for college. Sometimes some good things to pay for, but really think it through. Just don't get into the trap that it's always the right move to refinance. And again, it differs. A good lender will walk you through it and really show you what the savings are and if it matters. For some people, it's like, hey, I can save $300. I'm not worried about adding 3 years to, $300 a month on your payment. I'm not worried about adding, another 3 years to my loan. They're fine with that as long as they think it through.
Yeah, I know. Alp and I and our team, this is a topic that we go over a lot in client review conversations. When does it make sense? So what about purchasing a second home? So this is, broadly speaking, this could be a vacation home. This could be a rental property. And in fact, we've had a couple questions come in kind of around when's the right time, or when do you think you're financially responsible to buy an investment property to rent out? We're going to kind of touch on a few different topics here. I know both Alp and I have some different insights, opinions here. Kind of on the investment front, when do you know kind of you're ready to buy a house to rent out? Again, back to my very first point, right? Okay, if you're clear that, hey, this is an investment property, good. That's the first most important decision. And then you really want to go through, right, all the numbers, right? That Excel spreadsheet, right? Or if you're not an Excel kind of person, have someone help you, right? To really kind of start detailing out, all right, what are all my expenses going to be? What are all those fixed expenses going to be? And then at least that 1% rule, right? On the probably it needs to be higher, because just generally speaking, tenants don't necessarily keep up a property as well as a homeowner does, right? So if it's 1% for a homeowner to save for maintenance, it's going to be something higher. You should factor that in, and then what's the income that you expect to generate from the property? But you have to factor in that, hey, there's going to be gaps, right? There's going to be turnover, right? So what if there's 1 or 2 months a year where or you don't have any income coming in, right? You want to factor that in. And then kind of, I'll say, then there's the piece around what's your interest level? How much time do you have to just be involved, right? Because it does require time and attention. I personally have been a landlord for a few different properties here in DC. Some have been smooth and a wonderful experience, and others, let's just say, have been a challenge. You hope, you screen your tenants, and you hope you get really good tenants who pay their rent on time and take care of the property, but it doesn't always happen. And so are you going to be the one showing up to fix the leaky faucet, or are you going to hire somebody every time to do that, right? So to me, those are all kind of the most important things to think about.
And I'll reinforce, in my years of doing taxes, at times people that had rental properties, I've had people have properties destroyed by tenants, and it's something to be aware of, that it can happen. And I'll say, one of the things that you want to make sure, if you are a landlord, is that you want to try to limit it to just a single family being in your property, where I've seen a lot of headaches associated with, let's say, 2 or 3 families living in a home. And so the house gets really crowded, and just, they just don't take care of the house. So it's something to try to make sure you've screened your tenants well, and you feel that, hey, this is just going to be one family living in the property.
Yeah. And something that, another kind of phenomena that Alp and I have seen in recent years is kind of flipping some of this on its head, if you will, as folks maybe become empty nesters, get closer to retirement, or maybe into retirement, and they just say, you know what, I've owned a house for a long time, I've dealt with all the maintenance, right, and the yard upkeep, and I'm kind of over that. Right? It was fun while it lasted. I want to simplify my life. And so we're seeing some folks just go from being a homeowner to renting. And in a few cases, it was, just sort of went into it thinking this is temporary. We'll do this for a year or two till we kind of figure out where we want to buy kind of our permanent retirement home. But I think every example I'm thinking of, those have now evolved to, this is permanent. They're loving it. They're happy not dealing with owning a home, right? And financially, sometimes I think a lot of folks kind of sort of underestimate all those expenses that go into owning a home, even if it's paid off, right? Even if you have no mortgage on it, you still got homeowners insurance, you still got the real estate taxes,
and just the
maintenance, right?
Time to repair things, right?
Time. Yep.
Right. And I think on that subject, though, a lot of it really is they're going from a house to an apartment, and they're generally comparing apartments versus condos.
Yeah.
So that's where we see a lot of the renting now. They're saying, you know what, I'm happy getting a place in a city somewhere where I can walk to Whole Foods and Starbucks and have a kind of restaurants all around me, and so they're happy in that scenario.
So thank you, everybody. I know we're just a couple minutes over our hour. Let me just double check our question list. I want to make sure we addressed all of the questions.
And did we specifically, I know we went over the pre-qualifications, but did you give them a time frame of when you should start looking to get pre-qualified for a mortgage?
I don't recall if we did say that. Do you want to comment on that,
So
Al?
I'll just say, if you're really serious about buying a place, I think it makes sense to talk to that lender, and they'll give you those parameters up front. And if you're getting super, super serious, that's when you say, hey, I want to get pre-approved. And there's a distinction between the two that, you basically have a lender that's making a commitment to you as long as you buy a house in a certain price range and it appraises properly.
Yeah.
Trying to think what else question
Uh,
wise. And
yeah.
how much of a down payment is needed for a $450 to $500,000 house? Again, it's really a question if you're going to try to avoid, mortgage insurance premiums. But the best case scenario is if you can avoid that, and that's usually putting 20% down. If you can't, you just have to factor in the higher payments that you would have with mortgage insurance premiums.
Yeah, yeah, and there are different, lender programs out there that allow for, lower down payments. FHA loans, I think probably some of the most common, where I think they just require 3.5% down. But in pretty much any case, if you're putting less than 20% down, you're either going to add that mortgage insurance, line item to the monthly expense, or they're going to kind of backdoor it, and they're not going to line item out, but they're just going to bump the interest rate up slightly than what it would have been if you'd put the 20% down. Great. Really appreciate all the questions. As we said at the beginning, let me see, did one more come in? No, I
I
think
think
we
we talked
covered
about that
that
was
one. Yep,
about to rent a house.
yep,
If
got
you're
it.
ready to buy. Yep, that's
So follow us.
straightforward.
We've got recordings of all of our workshops available online. As I mentioned before, if you have follow-up questions, would like to schedule a time to chat, please don't hesitate to reach out. Always enjoy connecting with everybody, and obviously wishing everybody a happy and safe Thanksgiving. Thanks for joining us. Yeah.
Take care.
Take
Bye.
care. Bye-bye.